Do you think you were adequately regulated prior to the financial crisis?
Absolutely.
And do you think that all these new regulations have made your bank safer, have made it more efficient, have allowed you to better take care of your customers?
It's probably one of the biggest threats that we face today. I spend about $9,000 a year on loan loss reserves for real estate loans. We spend $120 to make sure we're in compliance.
All right, and would you say that these regulations affect more your ability to loan to wealthy people or to people who you might otherwise have been on the borderline and you might have taken a chance on?
The latter, for sure.
So you think it disproportionately affects the middle class and minority borrowers?
Absolutely.
Mr. Eagerton, I am a big supporter of credit unions. I am a member of the ILWU credit union back in my hometown, and I've worked very closely with my credit unions, who I give great credit to for being really the community banks in most of our communities. One of the things I think we can do to help credit unions is to lift this arbitrary cap that was not a result of Dodd-Frank, but it was a result of Congress in the 1990s put on this arbitrary cap on how much our credit unions could lend. And I think that I've been a big advocate of raising that cap, and I know Ranking Member Chu and I are both co-sponsors on the Credit Union Small Business Jobs Creation Act, which would lift that cap. I know the big banks are very opposed to that, but I would like to see that happen because I think that would do more than lifting regulations to allowing our credit unions to really get in there and make those loans. Could you just tell us what that would mean if Congress passed the bill on raising that arbitrary cap?
Well, first let me start with this. I think that's an excellent idea. Most credit unions today are capped at 12.25% of their assets.
Right.
So by raising that cap, you would allow credit unions to continue to do member business loans. What most credit unions find today is that just as soon as they get the program up and running, get the staff hired, they have to stop because they meet that cap.
Right.
So I think that's an excellent idea. The CFPB qualified mortgage rule, that basically hampers our business. We're not real comfortable with that. I can remember 20 years ago making my first mortgage loan. Thinking back, that guy probably had a 45% DTI. I still see him every month. He makes his payment on time, no issues. I understand that there's some opposition at the table that says that we may or may not be exempt, but that's a very wide line between us and the regulators. So yeah, I think that's part of it. And I also would like to see the CFPB have a 5-person bipartisan panel as opposed to just one person.
You know, CFPB is a figment of our creation of Dodd-Frank here, and it's very, to me, it's the most dangerous agency in Washington because it's unaccountable. It's there's no oversight, in my mind anyway. And once the director's appointed, he's there for his term. They're making rules and regulations without very little oversight or impact. They refuse to accept comments from the outside. And so, you know, in discussing this TRID issue, for instance, with the director, I mean, we're supposed to take him at his word that he's going to behave in a responsible manner, and not look at this as an opportunity to go after institutions. And it's very concerning to me, especially from the standpoint that I yesterday had somebody in my office who, it was a business, CFPB went after them from the standpoint that within their document, one of their operational documents that they hand to a customer is a phrase. And CFPB fined them $10 million because they're anticipating doing a rule down the road that this phrase would no longer be compliant with. All of you now are going to have a crystal ball sitting on your desk or be clairvoyant in order to know what CFPB may do in the future. This is how far we've gone. This is how over the top this agency has become. This is the environment that has been fostered by Dodd-Frank, and it's doing more than crippling access to capital for our people. It's crippling the economy.
Right, and so that's our guidance from the regulators, is that you guys, you should be doing more marketing and technology and taking risks. But I'm trying to show this trade-off that if you're constantly buying 3-ring binders and people to go through 3-ring binders day after day after day, you can't hire the person in marketing, and you can't hire the person in technology, and you're going to be reluctant to take risks. So, Mr. Mitchell and Mr. Eagerton, can you tell us how profound is the impact on your businesses when you have to pay for this regulatory thing, and speak to Ms. Gordon and the regulators so they get a sense of, hey, this is real. There's a real trade-off that's hurting us, and we're going to go out of business.
Compliance is just, it's really, the pendulum has swung way too far for our institution. We don't have a 3-ring binder, but what we do is we have a boardroom, okay? And so I'll assign 3 staff members to go in and look at Dodd-Frank Act. They come out a week later and they go, here's a stack. It's 800 pages. I'm sure you've seen it. But here's a stack that's going to affect our institution, and this is what we need to do about it. So during that time, understand that I have a staff of basically 20 people, okay? So for that week, they're basically out of commission. And then they're going to come back with a plan of action of what we're going to do. I really feel like that we're getting away from helping people and making sure that we make the loans that Washington agrees with. And I think that needs to change.